Welcome to The Explainer. Today, we are jumping right into a really fascinating case study. We're looking at the market DNA method live, in action on the DJ30. We're going to follow a trading cycle, phase by phase. You'll get to see exactly how this unique geometric system unfolds. So let's dive in. So, here's our roadmap. First, a quick overview of what market DNA is. Then, we'll track this cycle just as it happened in real time. Now, this is where it gets pretty interesting. The phases did not unfold in numerical order. We'll start with phase 1, the entry, then jump all the way to phase 3, and then come back to phase 2, which is where things are right now. We'll finish up with the cycle's current status and, of course, some important disclaimers. So, what is market DNA really? Well, it's a proprietary system that uses geometry for market analysis. It's super important to know that this is not your standard technical or fundamental analysis. Our goal here is simple: to document this cycle. We're just observing it phase by phase as it plays out. All right, let's get to it. Phase 1, the entry plan. This is ground zero for our case study. The whole setup, this initial geometric structure, was documented on March 30th, 2026. Okay, take a look at the chart. This is the initial geometric structure laid out on the DJ30. You can see the model points out two potential entry levels. The main one is right here, labeled M. And then there's a secondary entry, a little deeper, marked as PC. Now, let's break down the numbers for this entry plan. The primary entry, M, was set at 44,817.9. The secondary, PC, was at 43,814.2. That gives us a mean, or average, entry point of 44,316. The plan also lays out a trapezoid time duration of 42 days, which is basically the expected time frame for this whole cycle. The third triangle domain is 6.34%, a really crucial variable for calculating risk, and the risk coefficient is set at 1. So here's the key takeaway on how risk is managed. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. To actually run these calculations for the documented cycle, a hypothetical starting capital of $100,000 was used. And based on that capital, the plan calls for an expected maximum drawdown of 5%. Simple math, that means a maximum risk of $5,000. Putting all of those parameters together, the total calculated position size for the entire cycle works out to be 0.18. And the idea was to split that total position into two separate trades, each one sized at 0.09, one for each of those potential entry points we saw earlier. The initial plan didn't just define entries, it also set three potential targets for taking profit. Target 1, or T1, was the mirror level at 45,182. T2 was the apex N at 46,246, which is called a safe exit. And T3, the full exit, was all the way up at the trapezoid top at 47,284. So, this led to two different return scenarios from the get-go. Scenario 1, if only the first entry was triggered, the expected return was 2.22%. But in Scenario 2, if the price pulled back far enough to hit both entries, well, the expected return would double to 4.41%. Okay, now this is where the story of this cycle gets a little unconventional. You'd think the next step would be phase 2, right? Wrong. On March 31st, the market jumped straight to phase 3. And here's the proof on the chart from that day. You can see the price shot right up and tagged 46,246. That's exactly the T2 target, the apex N level from our initial plan. The original source documentation actually calls out this strange sequence of events. It says, and I quote, "Before the price touches the left trapezoid boundary, it climbed to the N price level." So that's a direct confirmation. Phase 3 happened before phase 2. So, what did this mean for the plan? Well, the first trade at the M level got triggered and was opened. But since the price moved up so fast, it never came back down to that secondary PC level. So this means only half of the total plan position was ever actually put on. Okay, that brings us right up to the most recent development in this cycle. On April 2nd, the market finally made it to phase 2. And this is the current status as of this documentation. If you look at this chart, you can see what happened next. The price kept going, and eventually came over and made clear contact with this line, what the model calls the mirror delay line. This event, the trigger for phase 2, happened at a price of 46,672. So let's just quickly recap this timeline, because it's pretty wild. The cycle started with a phase 1 entry plan, then it completely skipped a step and jumped to the end level, triggering phase 3. And only after all that did the price finally contact the mirror, kicking off phase 2. So the actual sequence of events we witnessed was 1, then 3, then 2. And that brings us to our final section for today. We're going to do a quick review of where this cycle stands right now, and then we'll go through some very important notices. And so, the documentation leaves us hanging with this big question. Will the next phase be phase 4, which would complete the cycle? Since this is an active, ongoing case study, that's a question that only time will answer. And finally, it is absolutely crucial that you take note of these disclaimers. This explainer is not financial advice. The documented method explicitly prohibits using leverage above 10. You should never, ever invest essential personal funds. These analyses exist only for documentation and public verification, and any risk management must strictly follow your own instructions. And that wraps up our deep dive into this ongoing DJ30 cycle. We followed the market DNA method through its very unusual path, phase 1 to 3 and then to 2. If you'd like to see more documentation, you can always visit the source website. Thanks for watching The Explainer.